STAG Industrial Stock, ticker symbol STAG. On the 30th of April, STAG presented earnings with a beat on FFO and revenue. The stock went up a little bit after the earnings, but on the year-to-date chart we see that STAG is still down 11%. But most people love STAG Industrial because of the monthly dividends, and I understand why, with dividend yield at 4.2% and 11 years of dividend increases. And here we see the total returns in the past 5 years including dividends. STAG returned 48%, while the S&P 500 is at almost 89%. A significant difference if you ask me. And with the stock coming down lately and the earnings just released, it is the perfect time to do an analysis. And I'm very excited to see what you guys think about this stock, so please let me know your thoughts in the comments. My name is Thomas and this is Thomas Invest. I'm an investor looking for great stocks at great prices. So what does STAG Industrial do? STAG Industrial is a real estate investment trust that is involved in the acquisition and operation of both single and multi-tenant properties. Although the majority of the portfolio is single-tenant industrial properties throughout the United States. Diving into the earnings, we see that STAG Industrial reported a net income of $0.20 per share, down from $0.28 last year. Core FFO, one of the most important numbers, was reported at $0.59 per share, an increase of 7.3% year over year. To me, this looks pretty good. Both produced cash NOI and same-store cash NOI are up similarly, also looking really good to me. The occupancy rate was reported at 97.7%, also looking really good. And overall, I think these results are looking really good. When diving into the more detailed version, we see that revenue is up a decent amount year over year. But as mentioned earlier, net income is down. Main reason being expenses and interest. To me, this feels like a short-term problem and not a long-term problem. STAG Industrial has a net debt to EBITDA of 5, which is a great number. I prefer a range of 5 to 6.5. Ratings are reported at B stable. I prefer A ratings here, to be honest, but B isn't too bad. Looking at the 2024 guidance, we see that core FFO per share is still expected to be in a range of $2.36 to $2.4 per share. Acquisition volume is also unchanged, and so is the rest of the numbers. In here we see the expiration schedule from 2025 to 2029. A lot of leases are expiring. I do think they are going to renew them, but it is important to keep an eye on them. Looking at the portfolio diversification, we see that geo breakdown looks really good. I prefer a max of 10% here, and Chicago is the biggest state in terms of ABR with 6.8%. For the tenants, it is the same situation. Amazon is the biggest here with only 2.9%. And looking at the top 10 and top 20 total shares, we see that this is under the 20%, so also looking pretty good to me. The top industry is air, freight and logistics with 11.5%. Again, I prefer a maximum of 10% here, but I'm not worried that much in this case. And now that we know more about the company, it is time to check the fundamentals of this stock. But first, if you made it this far into the video, I want to thank you a lot for watching this video. Make sure to subscribe to my channel to receive multiple analyses every week. And also join my Discord channel for free to meet other people within the community and to talk about stocks. It's completely free, so don't miss it out. Let's continue by diving into the fundamentals. STAG is a 6.4 billion market cap company. PE ratio is not a fair metric to use with REITs, so I'll be using the price to FFO instead. Right now it is sitting at 14.99, indicating they might be undervalued. Later in this video I will show you my 3 price targets for STAG Industrial stock, so make sure to watch until the end, because price to FFO is only telling a small part of the full story here. Revenue is at 721 million, and in this graph we see that revenue went up in the long run. To me, this looks really good. We see that margins are going up in the long run. This is also looking really good to me. EPS is going up in the long run. It is not always steady and consistent, but that's very common for REITs. Analysis expect that in 2024 EPS will decrease, which is really sad to see. But in 2025 it is expected to see an 11% increase again. For the revenue it is looking pretty interesting, with 6% growth expectations in 2024 and 2025. In 2026 it is expected to grow at 15% again. Return on assets is sitting at 2.86%, which is a low number, even for a REIT. Return on equity is looking pretty decent, and the most important number, return on invested capital, is sitting at 2.7%, which is again a low number. But it is slightly higher versus the 5-year average, so that's the silver lining here. Current ratio is at 1.76, which is a decent number, nothing really special to mention here. And right now STAG has 2.7 billion in debt. I prefer companies that can pay down at least a big chunk of their total debt with the total cash. STAG has 70 million in total cash, so they can't pay down a big chunk of their total debt. This is something that I don't like. So it is very important that free cash flow is growing, since this is used to pay down debt of course, but also to buy back shares, pay dividends and all other things. And here we see that free cash flow is going up in the long run, which is a great thing. Shares outstanding are increasing, which is very common for a REIT, since they increase shares to raise capital. When shares outstanding are decreasing, it increases your ownership in the company, increases the EPS, lowers the P/E ratio, and makes it easier to maintain and increase the dividends. And since we're talking about dividends anyways, dividend yield is sitting at almost 4.2%, which is a great number. Annual payout is at $1.48 and payout ratio is at 62%, which is below the 75% average for REITs. And keep in mind, STAG Industrial pays a monthly dividend instead of a quarterly dividend. They have increased the dividends for 11 years in a row, which is really impressive. In here we see the dividends paid since 2012. They increased the dividends at a low rate. However, in the long run this really adds up. In this graph we see the expected dividends in 2024, 2025 and 2026. Of course this is an estimation and can be highly impacted by results, but it gives you a rough indication. It is expected to increase slowly from here. And overall these dividends look really interesting to me, but how about the historical returns? I decided to compare STAG Industrial stock with the overall market, in this case the S&P 500. Next to that I added Americold Realty and First Industrial Realty. On the 5-year chart we see that STAG Industrial underperformed the S&P 500 with a big difference. STAG returned 48%, while the S&P 500 is sitting at 89%. And keep in mind, this is including dividends. FR had a 50% return, being the highest in this list excluding the S&P 500. On the 1-year chart it looks pretty interesting, with the S&P 500 beating all 3 REITs in this list. However, STAG Industrial managed to get almost a 5% return during a time where REITs were having a hard time due to rates and volatility. But both Colt and FR are seeing much lower returns. On the 6-month chart it is again the S&P 500 that is beating the stocks in this list, with a big difference again. On the 1-month chart it is still the S&P 500 that is beating all stocks in this list. However, all are at a negative number here. Bottom line, STAG underperformed the S&P 500 long term and short term. But could this be the perfect time to buy STAG Industrial stock? Well, let's check the 3 price targets that I created using the Everything Money software, which is one of the best tools out there. I'm using a low, mid and high assumption to get the 3 price targets, starting off with revenue growth. For the revenue growth I'm filling in 5, 7 and 9%, based on historical performance, their own outlook, but also because of the analysis. For the profit margin, I'm filling in 26, 27 and 28%. And for the free cash flow margin, I'm putting in 50, 52 and 54%. For the PE ratio, I'm putting in 20, and for the price to free cash flow, I'm putting in 16, 17 and 18. My desired annual return is 12.5% since I can get an easy 10% average annual return with owning an ETF. Right now, STAG Industrial stock is around $35. I hit analyze and we see a few green numbers. And since this is a REIT, I'm only focusing on the discounted cash flow value. We have a low price target of $29, we have a mid price target of $36, and we have a high price target of almost $45. And to me, the mid to high price target is the most justified here, indicating that this stock is undervalued right now. Which price target do you think is the most justified here? Let me know in the comments down below. My final conclusion on STAG is that it is really a great company. It's one of the smaller REITs positions, but I can't wait to expand my position. Most fundamentals look pretty good and they have been performing quite steady and consistent. From a dividend point of view, things look really good. They pay a monthly dividend, which is always an interesting thing. But above all, it is really safe and consistent. From a value point of view, I finally might get excited again. The stock has increased a decent amount in the past year, which means the valuation was a bit off lately. But now that it is coming down in stock price, it looks like it is entering the buying zone again. I made the decision to increase my position again and do this in small amounts, so I can get the best price possible, hopefully. I expect the stock to go down a little more in the coming periods with everything that is going on right now. And to me, the price is really good right now. But remember to always do your own research and never fully trust on what I or other YouTubers say about the stock. I'm not a financial advisor and this content is just for entertaining purposes only. I hope you liked this video and I did bring some insights of the company to you. I would really appreciate a thumbs up and make sure to subscribe to get notified when I'm posting a new video. Thanks for watching and I will see you in my next video.